Yeah, absolutely. So, hey, thanks for having me first and foremost, Brian.
Mhm.
For those of you that don't know me, I'm Eric Shirley, Director of Acquisitions at Four Oaks Capital with Brian. I've been in this industry for about 2 years now, 2.5 years, and kind of to what Ryan D was speaking about earlier with the Joe Fairless book. I've been involved in real estate for 20 plus years. I started flipping houses in college, part-time, made a ton of money doing that right before, did that really all the way up to the recession, right before the '08 bust. But I knew about mid 2017 that I'd started accumulating kind of a residential portfolio. And I knew that was not going to take me in the direction that I wanted to long term from a financial goal standpoint, like I'm sure many of you. So I started exploring commercial options, and multifamily was the most logical to me for many reasons. But I knew, because of the competitiveness of the space, both amongst our peers and the people in this room, as well as institutional and international buyers, there's a ton of money kind of flocking to the tier one primary markets. I knew it was going to be a stiff, kind of a tall order to get involved. And so before I chose to pick up the phone and reach out to a broker, I really thought it was important to educate myself and be able to speak the language. For those of you that have been involved in multifamily, it is truly its own language. If you haven't heard it before, it's Chinese. And so learning the terminology, learning what the different things are, like cap rates, and really being able to speak on an educated level adds so much credibility. So I spent about 8 to 12 months purely on education. I read every book I could. Much like Ryan had mentioned, I read the Joe Fairless book. I got involved in the Michael Blanc program. Anybody that I could find that was involved in multifamily syndication, I'd pick up the phone and reach out. And I know some people in this room, Jerome, Brian, Gary, people with experience that would be more than happy to, take your phone call and offer to buy them a beer or a coffee or whatever it took to get FaceTime with them to really get the educational component. So when I picked up the phone and called the broker, I was taken seriously, because they get a ton of calls from tire kickers all the time. And Brian knows this story well. This specific broker is a gentleman out of Greenville, South Carolina. And we reached out to him early on in our process. Again, I'd spent a year educating myself. About 6 months in, I reached out to this guy and said, hey, we're about to close on our first deal. We'd love to talk to you. And he literally, Brian had a similar experience. Yep. He literally told us, he said, man, I get 30 to 40 phone calls a day some days from people interested in getting involved in the Greenville, South Carolina market because it's so hot. He was like, I don't have time for you. Call me when you close something. And I was like a deer in headlights. At first I thought he was a jerk and I thought he was rude. And then the more I've kind of delved into this industry and the longer we've been a part of it, there's no way you could field 30 to 40 phone calls a day from people that are serious buyers, much less folks that really don't know what they're doing quite yet.
Yeah. So I'll throw in on that one. I thought about that a lot after, and he probably gave Eric the exact same speech that he's given to, probably hundreds of people trying to get in the game. But looking back at it, I far more appreciate his honesty than the dozens of brokers who were super nice to me and said, yeah, sure, I'll send you something, and then never return your phone calls, never return your emails, never return your texts, and never send you anything. So, yep. But yeah, that was the experience.
Yeah, absolutely. And it's, it's funny. It's amazing when you start to kind of learn the language and be able to talk the talk and walk the walk, the change in conversations that you have. They go from the broker vetting you to try to make sure you're worth their time, which I know sounds like a terrible thing to say, but that's the reality, to, them calling you and begging for your time. And it's really quite a change in the approach, which has been a nice change of pace.
Yeah, totally has. And actually, you know what? I probably started back asswards. I should have started on, with a lot of people who are trying to get in the game. I think one of the questions is, partners. Everybody realizes you need to have a team. And I know we had, Jamesia, I probably said your name wrong again. I'm sorry, Joe and Hema all say that, they're on a team. So we got a couple of people who are teamed up. So before we get to the deal specific, how did Four Oaks come together?
Yeah, so Four Oaks is not unlike many partnership stories kind of in this industry. the four individuals in Four Oaks. Two of us were friends of 15 years, myself and a gentleman named Brian Mallon, who's now kind of our director of investor relations. And we had been talking about wanting to do something together for years. So we decided, once I made the leap into the multifamily space and really committed to that, I talked to Brian about it. He was on board. He wanted to join up. So we founded a company called Third Ave Capital. And in the midst of trying to educate ourselves and really kind of get our first deal done, we were heavily involved in a networking space, not dissimilar to this, through the Michael Blanc program. And I'm not a coaching student. I see the value of coaching, but at the time it just didn't make sense. I felt like I could do it on my own. I would take that back if I could do it again. But at the time, that's my approach. And so Brian and I kind of went into this, and I was networking through the Michael Blanc program. And I posted a deal for review in kind of this chat room. And Brian Briscoe, our gracious host here, responded privately and said, "Hey, is this Tanglewood?" And it was a deal in Columbia, South Carolina. And we were both underwriting the same deal and competing for the same product. And through our conversation, we realized that we had been doing this for months. And so we were basically driving the price up on one another, trying to get involved in this and hurting each other. So we decided to try to team up and take that one down. And while we were not able to, we were second in that one. We didn't get the deal. We were the bridesmaid there. We realized that we really enjoyed working together, and we saw the value that each of us brought to the table. And then our fourth partner on our first deal, well, right before our first deal, I had another deal that we had submitted an LOI on. And our fourth partner, Todd Butler, had inquired about it and really got to know Todd through the investor process and learning. We really like to build relationships with our investors. And so through that process, we learned with Todd that he was going to be a great fit, and he had a lot of capital raising potential. He had a really robust network of high net worth individuals. And so we thought we'd bring Todd into the fold, and that's how Four Oaks was formed. We formed about 16 months ago now.
Yeah,
and in those 16 months, we've done 8 acquisitions, just shy of 500 units, 485 units, right at $25 million, and raised $10 million in capital in the last 16 months. So we really haven't looked back since that partnership began.
Yeah, it's kind of interesting. I actually, somebody was asking me questions about LOIs, and I went back and I pulled up one of our old LOIs. My company was Streamline Capital, and, little known fact that everybody knows, it was just me, and Todd was like Golden Mile, but one of the LOIs that we submitted had like all 3 logos on it. So it wasn't an immediate, hey, let's get together, let's form Four Oaks Capital. That first deal was kind of our trial run, and we realized that we liked each other. We worked well with each other, and we saw a huge, enormous future for us. So we decided to tie the knot, so to speak. So, yep. All right, now that I've done things chronologically and got us on track, so when we got to Clemson, if I remember right, we had 88 units under contract, and we were just looking for the next deal. So let's take it, not 88 units under contract, sorry, 88 units that had closed, and we're looking for the next deal. So take it from there.
Yeah, so to your point, we had 88 units that had closed. We had Wynwood under contract, so we had 168 units kind of tied up. And then this Clemson deal presented itself. And it was funny because the broker, who was the one that originally wouldn't give us the time of day, he called me and he said, "Hey, I know you like this upstate area. What do you think about Clemson?" I said, "I'm interested." And we were actually going to look at another property. He said, "Well, let's stop by this one and let's get your thoughts." He said, these sellers are interested in selling potentially. I'm not positive what their price would be. They won't give me a price. They won't give me any financials. So let's take a walk and see what you think. So we have been doing a ton of research in the upstate of South Carolina. So I had a really good gauge on, what 70s vintage C-class products should trade for. At this point, we were starting to fine tune our CapEx budgets and really get dialed in on that front. So I stopped by the property, looked at it, and my first thought when I pulled in was like, oh my gosh, this place needs so much work. Like, this is a big project, So after talking to the broker, we came up with a number, and it was $3.5 million, 82 units, $3.5 million, which worked out to be right around 43 a door, which pretty much any market, 43 a door is a steal. But it's really a steal in the upstate of South Carolina. There's a ton of upside up there. It's a really hot market. It's in the Greenville, South Carolina MSA. So we had no clue what it would take. The owners kept saying, just put in an offer. So we came in at $3.5 million, thinking it was going to, create dialogue and at least get the conversation started. And they said, great. When can you get us PSA? And we were like, what? So at that point, we went under contract, ironed out a few things, got into due diligence, and I'll stop right there. But it was we did not expect to get this at the purchase price. We just threw out a number, and they accepted it. It was a property. I'll give you a quick backstory. What we found out later was a group that owned this property, bought it in 2016 with all intentions. It's on a street right up. It's basically 2 miles from Clemson University's campus. And if you follow football at all, Clemson has won like 3 of the last 5 college national championships in football. And if you're a 20-year-old college age individual, a lot of people like to be in that kind of environment. It's a party school. It's in the ACC. It's in a great climate. And so it has grown exponentially since our football program kind of placed itself back on the map. So these guys bought this property in 2016 for $32 a door and had all intentions of bulldozing it and developing it. It's on a street with 8 apartment complexes in a row, and it's the last one. And it's certainly the ugly stepchild. And so they were going to bulldoze it, but right around the time they bought it, because Clemson was growing so fast due to this enrollment demand, the city of Clemson put in a moratorium on all new construction because their utility infrastructure could not support any new construction. And so these guys owned it and were putting no money into it because they wanted to tear it down. So why would you put money into something you're about to tear down? And they were just letting it go in hopes that this moratorium would be lifted. So when we came in and placed an offer, it was perfect timing for them to say, you know what, we've held it. The new building moratorium, the construction moratorium is still in place. So it was a good time for them to exit. And we were just able to capitalize, right place, right time.
Yeah. So let's go back to, the LOI. The LOI went in, I don't remember the exact date, but it seems like, if I remember right, early March, right?
Yes, correct.
Okay. So, world shut down for COVID. How did that conversation go with, between you, the broker, and the owner to keep this deal alive when, basically the whole entire lending market shut down?
So we went into due diligence and then COVID hit. So that was a lot of fun. So basically we couldn't get a loan. And it wasn't because it wasn't a great product. There was just so many. Bridge debt had dried up almost completely, or was just astronomically from a rate standpoint, because this was a dilapidated, or wasn't dilapidated, that's harsh, but it had quite a bit of deferred maintenance. And so the vacancy rate exceeded Fannie and Freddie. If you're trying to get agency debt on a product, which is backed by Freddie Mac or Fannie Mae, you have to have 90% occupancy maintained for at least 3 consecutive months. It's called stabilized. So the property wasn't stabilized. It was hovering around 15% vacancy. Going into COVID, we had concerns with this demographic and this tenant base, what the collections were going to look like. So we expected vacancy not only to fall, we expected to hover around that 15% vacancy mark, but then have some economic vacancy come in with collection issues. So we basically talked to the owner. They still wanted to sell. We still wanted to buy. And we said, let's press pause. You have our earnest money. It's sitting in escrow, and let's basically extend this due diligence period in perpetuity until the dust settles, and then we'll reevaluate. And that's what we did. We kind of sat on this thing for about 4 months and just waited for the dust to settle so we could reevaluate our lending options and kind of see how everything was going to play out as well. Because again, while this is not a student housing project, it is in a largely dominated college town. So the economy thrives on the university. And with COVID, we weren't sure that college was going to come back. And that's not a great place to be. If you own property in a college town and there's no college, that's not a great spot to be in.
Yeah. So fortunately, they wanted to sell. They had a lot of good reasons to sell. They wanted to sell. They were able to hold on. And incidentally, we had another property in Columbia that we had tied up with an LOI at the same time, and that seller didn't think the same way. So I think we were very fortunate to have a seller that was frankly willing to work with us, through the COVID, mess that it was. And all right, so fast forward a little bit, we got, we had it tied up for 3 to 4 months. At what point did we decide to push to the next step?
Yeah, once the lending environment kind of settled and we saw what our options would be, we felt comfortable moving forward. We knew at that price point at 42 a door that it was a steal. Right around the same time, and I hate to even call this a comparable property because it's not, but in Greenville, there was a 70s vintage C plus B minus product that went under contract for right around 94 a door and broke that area's record for a 70s vintage C class product. So while we didn't think that this product was going to be a 94 a door product, we felt extremely confident that at 42 a door, we had a lot of upside. And one of the biggest reasons for that was one of the comparable properties across the street, literally across the street. I could hit a 9-iron and knock a window out. That was a 60 unit property, very similar. So all 82 units of our buildings were townhouse style, which is townhouses are always in huge demand because you don't have upstairs or downstairs neighbors. You have neighbors on each side. So you basically have all of your living area downstairs or your common areas, and then your living areas upstairs. And they're all 2-bedroom. So if you wanted to have a roommate, you could do that. If you're a family with small kids, you have a room for the adults, a room for the kids. So they're all 2-bedroom, 1 bath, or 2-bedroom, 1.5 bath townhouse style. And right across the street was the exact same layout, basically the exact same vintage, but it had just been taken care of a little bit more nicely. It was 60 units. They were achieving the rent premiums that we were looking for at stabilization. So we were averaging rents right around $600 a month when we took over. The comparable property was right around $780 a month. And not only were they at 100% occupancy, but they had a 26-person deep wait list. So we felt really confident that our 3-year rent projections, if we used their numbers today with a 26-person wait list, that we would do really, really well if we dumped a large chunk of capital to fix this property up and really make it competitive. We knew that our underwriting would be extremely conservative in our ability to achieve those rent bumps.
Yeah. Now conservative underwriting, what did you use for your numbers as far as adjusting for COVID?
Yeah. So conservative underwriting, this is a hot button for me. So I'm going to get on my soapbox real fast.
Everybody is a conservative underwriter. I mean,
everyone throws out this term conservative underwriting, and it's garbage. Because if you're in a market that say is a 6%, on average, 6% vacancy, and you're underwriting at 7% vacancy, you can now technically say you're being conservative because you're above the average, right? But the reality is there's so much that can go on a 5-year hold. Conservative, there's nothing conservative about that. So for our year one, the vacancy, as I mentioned earlier, was right at 15%. With us taking it over, they had put no money into the property, and the property management was abysmal. So we knew we were going to bring in a great property management team. We knew we were going to be putting about $1.2 million into the property, $1.25 million into the property, which is about $13,000 a door. Now that's not all interiors. That's a ton of money to improve a property and really be competitive. So we had a ton of cash that we were going to dump into the property. I built in 23% vacancy in year one. Now, keep in mind, 23% means we have to average 23%. So in an 82 unit, you're looking at 22, rough math, 20 units that have to be vacant every single month for 12 consecutive months. So that's a massive cushion. Mm-hmm. In addition, we factored in flat rent growth, and our T12 in that project and that product, our year one pro forma was actually less than the T12. That's about as conservative as it comes.
That's conservative. Yeah, that's conservative.
Not only that, Jerome, we had this market seeing about the Greenville MSA is seeing about a 3.6% average annual rent growth over the past 5 years. We're factoring in 1.5% rent growth upon stabilization, which is below inflation. If you look inflation over the last 25 years, inflation's hovered right around 1.9%. Just shy of 2%. The Fed's done a really nice job. So we're saying once we stabilize in year 3, and granted, this is only a 4-year hold, but our stabilized rent growth from then on out is below standard inflation, which again is hyper conservative. One other place where we were super, super conservative is the average cap rate was around a 5.7% cap rate in this market for all the deals that had transacted. Typical conservative underwriting would say I'd add 10 basis points per year of hold. So on a 4-year hold, we would exit around 6.1, 6.2, even 6.25 would be competitive, or excuse me, conservative. We have our pro forma numbers exiting at year 4 at a 7 cap. So crazy conservative. So we were able to offer basically 16.5, 16.8% average annual return to our investor base on a 4-year hold. So it's basically a 1.625, I think, equity multiplier, or 1.865 equity multiplier, with all these crazy conservative cushions built in so that we can underpromise and overdeliver. Yeah. If we hit the numbers I truly believe it will hit, we'll show about 25% average annual return to our investors and double their money on a 4-year hold.
Yeah. All right. Now, speaking of the numbers, as far as, you know, the purchase price, the exit value, we got it appraised.
Yes.
All right. I don't remember the numbers off the top of my head. You got those numbers on the tip of your tongue handy?
No, I don't. It appraised for something like 3.8 million current as is. So we had $300,000 of instant equity, and then it appraised at the projected exit appraisal was at 6.7. And we had it exiting at a 7 cap, exiting at a 6.2.
Yep. Yeah. So if we hit the appraised numbers, you know, once we're done fully renovating, that's an extra $600,000 worth of profits to distribute to the investors. So one extra spot where we were conservative was just the exit cap numbers. You know, is there a chance that we get to a 7 cap, you know, between now and 4 years from now? Yes. Do I think it's going to happen? I don't, honestly, but you're always better safe than sorry, you know, using that more conservative exit cap on there.
Yeah.
All right.
And the cool thing about when you underwrite that way, just to kind of put this out there for those of you that are dipping your toe in the water, when you're trying to raise capital, the more compelling your numbers are and the better story you can tell, the more likely you are to have people, you know, want to take the bait, if you will. And so when you're underwriting extremely conservatively, when you have an appraisal that ties in all these different factors that show how conservative your underwriting is, and you start to build a track record, it makes it really easy to raise capital. We opened the raise on this, and I don't remember what the raise was, to be honest. It was just shy of $2 million. We did our webinar, our investor presentation, and we filled up every single spot in less than 48 hours. And it's a testament to a lot of things, but a lot of it's a testament to how strong. It's a testament to the job that Brian's done with the podcast and kind of what we had built up to have the number of attendees we had on the webinar. But because of the quality of the deal, people were literally like, I was halfway through the investor webinar and people were soft committing halfway through the presentation.
I've got the Wix app on my phone, and I get a notification every time somebody goes and fills out the form, and it was literally ding, 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 like anyway. So yeah, fun for us.
Yeah, it was good. It was, and it sets the table for kind of, you know, especially when you start building up in a specific market. This is our 5th asset in the upstate of South Carolina. And so it really starts giving us true operational efficiencies, not only in a property management standpoint, but in the maintenance and kind of volume of turns and the product that we're buying from a CapEx standpoint, as well as building broker relationships of now when someone has an off-market deal in the upstate, we're one of the first calls that happens because we closed 5 deals in less than 12 months in this market. And that resonates with these brokers.
Now, we've got a question in the chat. Can we go over deal structure, how we structure the deal and the returns to the investors?
Yeah. So we set up pretty much everything now as an 80-20 split with a hurdle. And so what that means is a lot of folks do preferred returns. We don't like preferred returns. And we don't like them for 2 reasons. One is a lot of the deals we do are heavy lifts. So there's not a ton of cash flow in the first 12 to 18 months. And when you don't have cash flow, it's really hard to pay a preferred return. Then you get behind the 8 ball and what you owe your investors starts building and building and building. And so we had some of our investors that came to us and said, listen, with these heavy lifts, if you have a pref, you're going to get behind the 8 ball for the first 18 to 24 months. And I don't want to be a part of a deal where the operator's not making any money. Because if you're not making money, we're not making money. Like if you're doing all these different deals, where is your motivation to keep putting your time and effort into this deal if you're not getting paid on it? And I thought that was pretty profound. So the way we structure it now is an 80-20 split where all our interest is loaded at that 80% to the investor. So the investor's certainly getting taken care of on the front end. And then with the hurdle, we normally do a 12% AAR hurdle. So say on a 4-year hold, the investor would have to get a 48% return. So 12% a year for 4 years. They'd have to get a 48% return on their initial investment. And at that point, it would trigger the hurdle, which would change the equity split from 80-20 to anywhere between 75-25 all the way down to 50-50. So it's basically, we don't do a capital transaction fee, or a disposition fee. So when we sell, we get asked this a lot. We do an acquisition fee on the front end, but if we did a disposition fee on the back end, it doesn't matter how well we perform. We get paid at sale. That doesn't seem right. If we do a crappy job, why should we get bonused on the back end just because we sold the place? Whereas if we build in a hurdle, there's a performance metric there. So once we exceed a certain performance metric, then the equity split changes, and any dollars after that, we get a little fatter piece of the pie.
Yeah, I really like that structure for a lot of reasons. I think you really have to, you really have to look at interests, and does the GP interest align with the LP interests? And we feel that structure more closely aligns, what we want and what we look for. And along with that disposition fee, I mean, if you build in a 1 or 2% disposition fee, like some people do, I'm not saying it's necessarily a bad thing, but I mean, the incentive to sell when may not be the best time is always there. But
Right.
All right, so we hit structure. Let's talk about our CapEx budget, and specifically plumbing, because that was kind of a big deal. Still is a big deal because we're chasing down the problems right now. So when did you realize first that there was going to be an issue with plumbing, and then walk us through the due diligence steps you took specifically to address that?
Yeah, so this was scary. So there was a plumbing issue. So if you looked at the T12 up until August of 2019, so a year ago August, the water bill had hovered anywhere between $4,500 and $6,000 a month, just depending on the month. The August of 2019, it jumped up to just shy of $8,000. September of 2019, it jumped to $12,000. October, it jumped to $15,000, and it hovered in that $12,000 to $15,000 range up until now. I mean, still there. Mm-hmm. So we knew there was a massive plumbing leak. And the problem is, to find a plumbing leak, you have to shut off the water. And the current ownership group was not willing to let us shut off the water on the property they owned and put their tenants out. That was a problem for them. And we couldn't find, we brought every plumbing company in the Southeast out there to run cameras and try to figure out what the issue was. And basically no one could come up with an issue. Everyone was speculating. And the speculation was basically, we'll dig up every single, so you can't pull the pipes out of the walls, right? The copper pipes that are in the walls are in the walls. And you can have a slab leak and things like that. But those are little things that you can fix kind of along the way. When your water bill goes up threefold, you've got a major leak somewhere. And we had a company come out with acoustic resonance trying to find the leak, and no one could find it. And basically they said, all right, let's just budget. If we were to bring a bulldozer out or backhoe and dig up every single piece of exterior piping and replace it, it's going to cost about $170,000. I said, that's not an option that I like very much. That's a massive guessing game. And for those of you that look at the way syndication works, when you're raising money, if I have to raise $200,000 for a plumbing budget, and I'm raising it from an investor at 16 to 18% average annual return, that is massively expensive money. So to change my CapEx budget by $200,000 can kill a deal. Like literally can kill a deal. So we went back so we finally found a company that came out and said, I mean, I could spend a whole night on plumbing, but they felt pretty confident they had identified the source of the leaks. And they said, we feel confident that we can get these leaks under control for $50,000. And we retraded. We went back to the sellers and said, listen, you guys have a massive plumbing leak. They were unwilling to fix it, and they knew they were not going to fix it because they wanted to bulldoze it. Why would you spend $200,000 on plumbing if you're going to bulldoze a place as soon as this moratorium this moratorium lifts. So they basically, we beat them up and we went back and forth. They agreed to give us a $50,000 credit for water. So we ended up building in a $200,000 budget for worst case scenario. If we have to dig up every single piece of external pipe, that's what we have to do. And we know what that's going to cost. We built that into our budget, but we knew that we had a $50,000 quote basically to get it done. And so we're in the midst of the plumbing repairs. Thus far, they found one major leak and then they found 19 small leaks. The major leak was literally the equivalent of if you had your bathtub running 24 hours a day, 7 days a week, underwater or underground. And it was dumping into its clay and it was dumping into an underwater reservoir. So it was not bubbling up anywhere. So there was no way. It was actually bubbling up about 1,000 yards off the property, believe it or not. And then the 19 small leaks were the equivalent of some were drips and some were steady small streams. And then once the plumbing's done, which will be done next week, we'll do the pressure testing on each of the units and repair any slab leaks. But we should have the plumbing completely rectified for under $75,000. And then we'll have an additional $125,000 of overcapitalization that we can use for other projects, hold in cash reserves to ride out any additional storms that may come our way, or we can return that capital back to the investors to reduce the amount of capital that we're holding and the amount of return that we have to pay out.
And just to put things in perspective, you know, he said $12,000 per month on the total plumbing bill, which, you know, quick math in public, that's what, $150 a month per unit. Now, when you look at what's going on, this is the benefit to having many properties in the same area. One bedroom properties are averaging about $35 a month there. And two bedroom properties are averaging between $40 and $45 a month. So, you know, when we're looking at
for billbacks,
what's that?
For billbacks, right? Water billbacks. Yeah,
that's what we're giving. That's what we're charging for our water billbacks, which is really close to what the overall bills are. I mean, the one law in South Carolina is we can't make money on billback. So we are billing back $45 a month for two bedrooms, which means the real water bill is somewhere between 45 and 50 is about the going rate. So, you know, when you put things in perspective, the water bill is about 3 times what it should be. And then on the flip side, once we cure the water problem or get it under control, that's going to add that much more just back into our net operating income at the end of the day.
Yeah, we're really excited. The plumbing repairs are going amazingly. That the property as a whole, we've only owned it now for about 5 weeks, 6 weeks. And it's been a phenomenal transition. The amount of the number of tenants, I've been on site 3 different times since we took over, and the number of tenants that have approached our management company and just elated to see someone that's actually going to put some money into the property. People are so excited to have a place that they can be proud of to call home. And we already rented 3 unrenovated units with the new management company for, on average, they were renting for about $600 prior. We've already gotten 3 contracts signed for $700 plus rubs, and we haven't even put a dime into those units yet. Yep. So we're going to knock the cover off the ball on this property.
Yep. Yeah. So that's real good. So let's talk debt right now. I mean, you alluded earlier that at first our debt kind of dried up. What loan did we end up getting, and walk us through that process?
Yeah. So agency debt was a no-go again because of the vacancy concerns. Bridge debt had dried up and had become super expensive. We really don't love bridge debt, traditional bridge debt, because of the term. So we decided to pursue a recourse product. We felt so confident in this product and in this asset and in the underwriting that we put our own balance sheets on the line and got a recourse product from a local financial institution. We were able to get 75% loan to cost, which was a huge win. It delayed things about 6 weeks. But it's going to be totally worth it for the investors. They're going to see a 1 to 2% increased average annual return because of that loan. But we get 75% loan to cost at 4.5% interest, 20-year amortization on a 5-year term. So really, really nice numbers. We're further establishing our relationship with financial institutions locally. To put it in perspective, because of that, we just put another product under contract that we're taking down ourselves, a 28 unit, literally a mile down the street. That's also 2-bedroom, 1-bath townhouse units. We got that off market from the exact same broker for 32 a door. 32 a door. It's crazy. Steal. And we got 80% loan to cost on that at 4% interest, 25-year amortization on a 5-year hold. So they're giving money away right now. Money is so cheap. So, but again, this Clemson one, it was 75% LTC, which was anytime you can get your CapEx rolled into the loan, it's a win.
Yeah, I'll just key in on that point. I mean, a lot of people will say, don't go the non-recourse route. Okay. And I think my opinion, obviously we've done a recourse loan. This is our second recourse loan, and actually our second recourse loan with the same lender. But I lump this in as like the overall risk profile. Most of you guys know I'm an active duty Marine, and one thing that we do a lot is what we call risk management. And I think we look at apartments the same way. We look at the overall risk profile. And if we're confident in the numbers, a recourse loan isn't that big of a deal, So, and the difference between a recourse loan and a non-recourse loan, if anybody doesn't quite know the terminology, is, hold on, I might get these confused. The recourse loan, I may have been switching my terms around. The recourse loan, we are personally liable for the loan, just like you are on a mortgage.
Personal guarantors.
Yep. So if the property isn't spitting out enough money to cover the loan, we've got to reach into our back pocket. All right. The non-recourse loan, our personal assets are protected. So the property, the lender can go after the property and that's it. So anyway, in this case, the lender can come after us personally and hold us personally and financially liable for the property. So, and incidentally, I just threw a link to our pitch deck in the chat box. So if anybody wants to look at the details, I know we've gone over a lot of details today, but if you want, in your own time to look over those details, the link's right there. All right. So you mentioned, Eric, we had a marathon closing. Took us, waiting for the loan essentially. And part of that was because the bank we were working with got bought out by a bigger bank. But after the marathon, take us to the closing, and you've brought it up before, but take us to closing, and then the first 6-7 weeks of operations.
Yeah, so we finally were able to get over the finish line. We had 2 competing financial institutions basically fighting for our loan, which was good. So we could pit them against each other. We went with the relationship that was pre-existing. I was a little bit better terms. So we closed on November 2nd, took over the property, and really haven't looked back since. We had about a $600,000 CapEx budget for the exteriors. And that process has started. We're replacing all the roofs, replacing the mansard roofing with board and batten LVP siding, all new energy efficient windows, pressure washing, new landscaping, new signage, amenitization. So we're full steam ahead. We are still experiencing some challenge from a collection standpoint. Greenville, unfortunately, is a very South Carolina is a landlord-friendly state, but during COVID, the judges in Greenville are siding with the landlords siding with the tenant base and the resident base, regardless if they have their documentation in place. So we're teed up, and we never want to evict anyone that's trying to help themselves. And so anybody that reaches out to set up a payment plan or says, hey, I'm trying, we will do anything and everything in our power to help these folks, whether it's set them up with, put them on a payment plan, set them up with local assistance groups, which we work very closely with the community on. Anything we can do like that, we do. It's the tenants that refuse to return your phone calls or tell you, screw you, I don't have to pay. I'm exempt from this. I had COVID. So we have a nice list of about 12 folks right now that as soon as January 1 comes, we'll file on them January 2nd. and try to get some sense of normalcy back in the property. But to what Brian mentioned earlier, we built in this massive cushion in year one that, we not only is the underwriting accommodating for really anything that comes our way in the first year, we also have $200,000 of cash reserves sitting in the bank on top of our CapEx budget to really weather this storm and anything that comes our way. So we're in phenomenal shape. And we're just really starting to the momentum starting to pick up. And what's really helpful is we own an 80 unit right down the street, about 12 miles away. Mm-hmm. And 25% of those 80 units, we've owned that property for 6 months. 25% of those 80 units, we're already getting our year 3 rent projections in the first 6 months. So we're crushing that deal. And if we keep that up, we'll be able to sell what was projected to be a 6-year hold. We'll sell at the end of year 3. And so that's helping bring kind of that whole, the rising tide lifts all ships. Well, we own 3 assets within 12 miles of this one property, and they're all growing. And we have a 4th under contract that will close on December 30th. So all we're doing by owning all these properties in such a tight-knit geographical area is we're helping each of our sister properties out. We're just driving values up, which has been really nice. And we're building that really strong broker relationship where people come to us when there's that 28 unit I mentioned earlier. We put that under, we got a whisper from the broker that said, hey, this is going to go to market tomorrow. We looked at it that day, submitted an offer, had it under LOI that night. It went to market regardless for backup offers the next day. They got 8 offers the first day they went to market. If we did not have the reputation we had, we would not have gotten this deal for $32,000 a door.
Yeah, that's the holy grail for an acquisitions director is to get that call from the broker 100%. Before it gets pushed out to everybody else. So we had a couple questions in the chat, and one of them, I think, Bastian, you got a great question there. Did you have to bring in a KP, and how is the share for a KP different for a recourse and non-recourse for a loan? So great question.
Yeah, so we did not have to bring in a KP. From a balance sheet standpoint, Four Oaks was in a position where we can take out something really kind of into that $7 and $8 million range. So we're in good shape there. Because it wasn't an agency loan, we didn't have to have an SREO, which is really someone that an SREO is a schedule of real estate owned. And a lot of times Fannie or Freddie wants someone to sign on the dotted line that has 2 years of agency debt experience within a similar geographical area, as well as similar in size. So we did not need that. However, we have a 167 unit deal in Augusta, Georgia that we close on next week that we thought we were going to need a KP on. We've done 3 agency debt deals thus far, and that would be our biggest to date by about double. But fortunately, because of our track record and because of the success we've had thus far, we were able to get a Fannie loan assumption without any additional KPs, which was a huge win. So we've done, and loan assumptions are the hardest kind of loans to get. They're actually more critical on a loan assumption than they are on new debt. So we have 2 deals that we've got, 3 deals that we've gotten original debt on. Fannie.
So the 2 Spartanburg ones have Fannie.
Yeah. Wynwood was an assumption.
Wynwood was a Freddie assumption. This is a Fannie assumption. So we've got two agencies, and then we got 2 bridge bank loans.
Yeah, 3. We have, yes, something like that.
2 agencies where we pursued original debt.
Northway's original debt. So we'll have 3 with original debt, okay. 2 loan assumptions. So 5 agency deals, and then 3 local financial institution deals.
Yeah. Yep. So good numbers there. And then the second part of your question, Bastian, is KP different for recourse and non-recourse? It is going to be, because the KP is going to have their balance sheet on the line, and that's something you're going to have to just negotiate with each individual KP who comes in the gate. But the risk for the KP is significantly higher in recourse debt. Mm-hmm. If you're bringing in an outside KP, so they will want significantly more. Yeah, and if you think about it, let's say that out of a 4-person partnership, 3 people have a net worth of $250,000, and 1 guy has a net worth of $10 million. Okay, and it's a recourse loan. If you default on the loan, who is the bank going to go after? Okay. They're going to go after the guy with, I don't remember what number I spit out, but the $1 million balance sheet as opposed to the $250,000 guys. So when you look at that, if you're bringing in a KP for a recourse loan, he's exposed, or he or she is going to be exposed to a lot more risk. So you're going to have to pay for it.
In this Clemson deal, we do have a KP who's a buddy of ours. And we ended up giving him a fit. We split the deal the GP 5 ways. So Four Oaks got 80% and he got 20%. There were multiple strategic reasons to bring him in on that deal. He certainly didn't hurt the balance sheet. He has about a $40 million net worth. So that was a good thing to add to the balance sheet. But the flip side of that was strategically, it made a ton of sense for us to give a small piece of the pie. 20% respectively is relatively small, all things considered, as an act of good faith for future opportunities, which we've already capitalized on. He's been invested both personally and as a KP in our next 3 deals.
Yeah. And that's, and giving up 5% to have him on our side for, the future was very easy.
No brainer.
Yeah. It's like, okay. Yeah. 8 days a week, twice on Sunday.
Yeah.
Dave
asked real fast, what is a KP? And a KP is called a key principal. And Dave, traditionally, lender wants, like with Fannie and Freddie, whatever the amount of the loan, they want you to have that amount, a net worth of that amount combined in your general partnership.
All right. And to Ryan D's question, you have a large vacancy rate built in for a buffer. Does that cover costs of legal portion of eviction processes and those that are refusing to pay rent? Yes and no. It covers economic vacancy, which is people who are refusing to pay rent. That number doesn't necessarily cover our legal costs. That's a separate line item on our underwriting spreadsheet. So we did boost that up. I don't have the numbers on the tip of my tongue, but we did account for a larger legal costs, year 1 to account for, potential higher eviction rate.
And it's important to know when you're underwriting, know your state and know your county and know what the filing costs are. It only costs about $30 to file where this property is.
Yep.
We can evict a ton of tenants for $30.
For very cheap.
Yeah. DC is one of the least landlord friendly states on the planet. You're going to spend much, much more than that in legal fees to evict a tenant.
Yeah. Yeah. Fortunately, we like landlord friendly states to invest in, first of all. And fortunately, South Carolina is a very landlord friendly state. And then, so there we go. All right. Well, we're at the 1 hour mark. So let's do this. If you got questions still going, go ahead and either take yourself off of mute and ask, or, drop something in chat. And we'll spend about, 5 or 8 more minutes, running through questions if we have any before we roll into our networking. Bueller.
I got a question here.
All right.
So back to your guys, how you guys set up your hurdle. Can you explain that a little bit more? Is it 12% per year for the entire hold period, and then it kicks in on the sale? Is that what you're saying? That's why there's no disposition fee? So
it kicks in on the sale, but semantically. So when you think about it, Blake, if you look at it if 12% is the number that you have built in for the hurdle, right? The only way for it to kick in, you would either have to have a cash on cash return of 12% a year, which please let me know if you ever find that, because I'll invest in that. That's a home run and a half. But you either have to have 12% return, cash on cash, or it's going to kick in at the time of sale. And it's basically every dollar up to that 48% return to the investors goes 80-20. And then once you hit that split, every dollar after that. So if you sold it and you had $2 million in proceeds, it doesn't mean all 2 million of the proceeds go to 50-50 because you hit the hurdle somewhere in the sale.
Just the proceeds above the hurdle gets
correct. So maybe the first 500,000 were below the hurdle, and then the next 1.5 million. And so that's really how we make so this is a giant misconception about multifamily investing is how you make money. You make money on when you buy and when you sell. The cash flow does not make you money. Cash flow keeps the lights on. Asset management fees keep the lights on, and hire employees and bookkeepers and all that fun stuff. You make money with acquisition fees that you need to live off of. And the way we structure our business is we live off our acquisition fees. And when we sell, we take our disposition, our proceeds, and we buy our own properties. And that's the cash flow we live off of, because then we own those 100%.
Gotcha.
It's really hard to make money off cash flow.
Unique setup. I haven't heard it like that. So
yeah. And Blake, I'll take it one step further. There's lots of ways you can implement the hurdle like this. But most times when you implement a hurdle, there's what's called a look back clause. So for example, let's say we had a lower hurdle. Let's say we had like an 8% hurdle, and we were hitting that 8% cash on cash year on year, which is a lot more realistic. Okay, so if you have an 8% IRR or AAR cash hurdle and you're hitting that money, you could implement that change in equity prior to. And if for some reason you dip back below, there is a look back clause, which means that the GP stops taking money until, or at sale, you look back to what you paid out to your investors. And if you haven't met that number, the look back clause will make up for it. So you could retroactively pay people back if you didn't quite hit that hurdle, 1 or 2 years. So may have gotten a little too technical there, but there's lots of ways to structure that. And, graduate course in real estate finance right there.
Yeah. Let me piggyback on that too, because I think this is important as you build your brand and you build your investor pool or your potential investor pool, you're essentially, this is going to sound harsh, but I'm going to just try to make it as black and white as I can to stay out of gray. You're training your investors on how to think about multifamily. You're their expert. You're their resource. So if they're not familiar with the multifamily asset class, they're leaning on you to understand how this works. And they might listen to some podcasts, and everyone has these hot buttons like prefs, preferred returns. And I'm not saying preferred returns are good or bad, but people say you can't get investors without a pref. That's just the way the world works. People have also told us we can't get a 50-50 hurdle after 12% split. We've done both. We don't have prefs, and we get 50-50 hurdles regularly after a 12% AAR. And our investors are elated because we're crushing it for them, because we underwrite conservatively. I sort through 60 to 100 deals a month, and we submit maybe 2 LOIs a month. So if you look at it on a quarter basis, we're looking at 300 deals and we're submitting 6 LOIs, and we're getting 2 to 3 under contract per quarter. Think about that. The amount of garbage we sift through to get to something decent. And our investors know that. But we've done a really good job of educating our investors on, don't worry about these hot buttons and don't get shiny object syndrome. Let's look at what are your actual goals and how can we help you to achieve those? Because at the end of the day, we have, this drives me crazy, and Jerome can appreciate this, I'm sure, a ton. And hey, Hutch, how are you, buddy? So we know guys that look at B-class product that's in Charlotte or Raleigh or Atlanta, Jamaica, you can appreciate this in Atlanta. You see these deals and they're 90s, early 2000 vintage, and people are like, I'm investing in that. Look at that property. That's a 1995 vintage in Atlanta with a 22% average annual return. I'm in. They don't know what they just invested in. This jabroni this Yahoo that came up with the underwriting on this thing is looking at 4% average annual rent growth upon stabilization, and they're pushing rents to the top of the market. And they're only going to put $4,000 per unit in to do granite and stainless and all this stuff. And the underwriting is crap. The underwriting's garbage, and garbage in, garbage out. But they're investing in it because they saw a shiny B-class property and they're stoked. They're like, oh, this is amazing. It's garbage. Don't invest in deals because of what they look like. Our C-class product, there's nothing sexy about it. But I may say this all the time. We're not buying C-class assets. I'm essentially buying ATMs. And every month I go by that ATM and it spits out tons of cash. And that's why we're in this, to make money. We're not in this because we want to wear a badge on our back that says, oh, I own 200 units in Atlanta. Who cares? My product is doing better than your product, and it doesn't matter where my product is because I underwrote it the right way. So know your underwriting, underwrite well, and your investor base will thank you, and you'll grow your investor base exponentially because of it.
Yeah, we were actually talking about this, Eric and I, on a conversation a little earlier today. We look at deals and then we see what other people finally get them under contract for. Just one concrete example on, actually, I won't even say the city just because people might connect the dots, but a city where we bought something at $45K a door, or we underwrote something at $45K a door, wasn't going to work for us, couldn't meet the whisper price, and it's under contract right now for $55K a door. So it's just one of those where you kind of scratch your head and you're thinking, I wonder, and we really do. We wonder what is on their underwriting spreadsheet. What numbers are they cooking in, coming in with? But
and we hope they do well, because if they do well, my God, we're going to crush it.
Yeah, and I'm happy to see them lock something up for $55K a door in a city where we're purchasing at 42, or in a neighborhood where we're purchasing it at 42, because that's going to be one of the comps.
Yep.
And when there's, everybody focuses on the cap rate NOI equation. That's only part of the valuation deal. Okay. There is a significant portion of the valuation that actually comes in with the comps, not only where the comps are, on NOI and cap rate, but the price per door on the comps matters as well. The price per square foot on the comps matters as well. And if you ever doubt that, just pull up any commercial appraisal, and it goes through 3 or 4 different valuation methods, and the comparative value method is one of them that they use every single time. So
when Briscoe can tell you, we don't look at cap rates when we buy a property. Cap rates are completely irrelevant because we're not buying stabilized assets. And so we have investors every single deal. This Clemson deal, I had a guy say, "What are you buying this for?" I said, "A 3 cap," and his jaw about hit the ground. But if you think about it, if you have a property that has negative NOI because it's being that poorly mismanaged, they should technically pay me to buy it from them. So cap rates are worthless. The only reason you need cap rates going in is so you need to know stabilized cap rates so that you can come up with your exit cap at resale. That's it. Cap rate means absolutely nothing at acquisition. It's not, because you're not buying the property for how it's performing right now. You're buying the property for the future value and what you're going to be able to do to it. So if with your conservative underwriting, if it pencils out well, it doesn't matter if you buy it at a 1 cap, a 2 cap, a 30 cap. It's irrelevant.
Yeah. All right. That's it. Do we have any last minute questions before we turn this into an amazing networking event? I heard somebody else come up.
I have a question.
Jerome, what's up, man?
What's up, man? All right. So break down for me how you're forcing the appreciation, because your rent growth is so conservative and your cap rate, which is the 2 levers that everybody pulls to grow valuation, is really low too. So is this an expense play? What are you eliminating? How are you driving NOI?
No, so year 1 is the super mellow, flat rent growth. We're bumping rents roughly $200 over 3 years. So we're going, that comparable property I was talking about earlier that can hit a 9-iron too, they're getting basically $800 a month right now with rubs on top of that, with a 26-person deep wait list. So we feel extremely confident that our product, which is the exact same year and the exact same layout, we just have more units and we have more green space to amenitize. We feel extremely confident, and they're getting $800 today plus rubs. Our 3-year rent growth is $785 plus rubs. Yet again, hyper conservative. So in 3 years, if we're not getting what they're getting today, we're in trouble. But we feel extremely confident we can do that. And then exiting at that 7 cap, again, I try to make, this is where I get myself in trouble sometimes, Jerome, is investors aren't always trained to think the same way that my brain is a scary place sometimes. And so when I present underwriting to folks, especially on an investor call, you hear this stress testing, make sure it's stress tested. When I present underwriting, that is my stress tested. Like I've got 23% vacancy in year 1 and 15% vacancy, I think, in year 2. That's and a 1.5% average annual rent growth and a 7 cap at exit. Like all these different conservative things are built in. So realistically, I can show a 19 or 20% return. But what I tell all of our investors is if you're investing and I tell you 20%, I'm going to give you an average annual return of 20%. I come in at 19.2%. You made 19.2% return on your investment annualized in a tax-free environment, you should be giving me hugs and sending me Christmas flowers. But if I told you I'm giving you 20% and I only give you 19.2, I've disappointed you.
Yeah.
I underachieved. And that we're not in the business of underachieving. So I'd much rather tell you 17 and hit 20 or hit 22 or 25. And now you go tell all your friends than the reverse.
Yeah.
It's amazing how quickly, and that's why we don't even do, some people will do worst case, what we think, and best case.
No.
But let me tell you a secret. As soon as someone sees best case, that's now reality.
Yeah. Well, that's where they're going to go too. That's
exactly. And they're going to hold your feet to the fire. And so we don't do that. We say, if you're happy with 17% with a ton of upside in a tax-free environment, we're your guys.
Phenomenal job, Eric. Thank you for sharing this.
Thanks,
yeah, I have a question for Eric. Just real quick, it sounds like you're underwriting a lot of deals.
Yes.
Or at least looking at a lot of them. Where are you finding these to underwrite? Just, I'm struggling to try to find a lot to underwrite.
Yeah. So honestly, it started off early on with, we were just being fed garbage. We were just being fed garbage. And I made it and Brian will tell you, my mission was to get back to every single broker that sent me a deal within 24 hours with some form of feedback, and not just feedback of it's too expensive, detailed breakdown of where I was coming in and why that deal didn't work for me. And so even though, and I think it's in every book out there, it's in Joe's book, it's in Michael's book, all that, even though the deal didn't work, the brokers learned our underwriting and saw that we knew what we were talking about. To the point that I actually have brokers and Scott, our lending partner, that if they have a deal that's tight, they'll send it to me to underwrite just as another set of eyes to give them feedback on where they think it should come in at.
So it sounds like brokers are your main source?
Yeah, we don't do anything, but we're to the point now where I'd say of the 60 to 100 deals we get a month, 50% of them are off market. The other 50% that we get that are on market are typically Cushman or M&M or one of these big brokerage firms that everything goes to market. But yeah, we're getting a ton of deals. Like today, I got 3 deals today. All 3 are off market deals. We passed on, I underwrote them collectively in about an hour for all 3, and we passed on all 3.
Great. Okay. Sounds good. Thanks.
Yeah, absolutely.
And that 24-hour, get back to all the brokers. That's hard to do. It really is. A year ago, a little over a year ago, we teamed up on our first couple of properties on the underwriting, on the acquisitions, and it's really hard to do. But when you do that, the brokers are going to keep on coming back to you because they know you're going to look at it. They know you're going to take it seriously. They know that the email is not just going to hit your spam folder and never see the light of day.
I've got a 330 unit I'm working on right now that the broker and I have been going back and forth with the seller trying to get them down. I actually submitted my underwriting with the seller today so that the seller could see where we're coming from and try to get basically, I keep saying you're too expensive. Your product's not worth what you think it is. If you want to sell, and they have motivations to sell for certain things going on in their company, if you want to sell, here's where I'll come in at, and here's why this is a fair number at a fair cap rate.
Yep. All right. So I do want to get to networking. So we had a lot of good questions. I don't see anything else in the chat room. So what we're going to do now